Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Okay, everyone. Welcome to the show. Thanks for joining us today as we get under the hood of property investment and what's going on in this crazy, wacky world in which we live. And that's what a lot of people will tell you. I've been having quite a lot of interesting conversations recently with people that work across property investment, both people who do it as an advisor, but also people who invest themselves. And most people, by and large, are reasonably fatigued by a lot of the noise and rhetoric around softening markets. The smart people I know, and I guess the segue for the Smart Property Investment Show, are those people who are seeing opportunities in this particular market. And I think a lot of people are considering it as generational opportunities. Last time we had softening markets like this, it's called the GFC, even back 20 odd years, when markets come off as they have done, you're looking at interest rates which were, exorbitant compared to where they are today. So there's a lot of weirdness happening in this market right now. A lot of people are trying to explain and understand and appreciate just exactly what's going on, the drivers for this softening market. A lot of people calling in the Royal Commission, which if you've been tuning in, we've been talking a little bit about the findings are going to be handed down pretty soon. You might even hand it down by the time we have this comes out. So we'll definitely do a bit of a diagnosis on that and understand what's going on and try and give some narrative around it all. Obviously, election years, tighter funding from lenders, even though that might be coming back a bit, higher serviceability. So lots of moving parts. That's changing markets right across Australia, and you get to choose as an property investor exactly what you think about that and how you act, how you operate, how you behave with the information that you know. So as I said, the smart people I know are looking for opportunities right now. They might not be buying right now, but they're definitely getting themselves set to do so. Brought someone into the studio today, Matt Preston, had a bit of a chat about what he's doing in property. He's been investing in property for quite some time. He also works in this space as a mortgage broker, but we're going to talk about more of him as a property investor. He's listened to the show beforehand, particularly one of his clients who he's looked after, Jeremy Yarnazelli. Jeremy, I know you listen. How you going? I hope you're doing well. He said he's listened to your podcast and he said that you stutter a lot and you can do it much better next time. So, Matt, you're in the driving seat now.
I'll show him how it's done.
You're going to show us how it's done. How you going, mate?
I'm well. How are you, Phil?
Good. What's going on with property for you at the moment?
Oh, wow. It's a broad question.
It is. a nice open-ended question to kick things off.
We're a holding phase. What a boring answer that is. But I mean, actually, on the way here, I was telling my dad, who I bought the last property with, we were just sort of counting back to when it was. We just re-signed the lease today. So that was 2 years ago. That was our last purchase, a little off-the-cuff thing in Newtown, which I never would have thought I'd be buying in Sydney during the peak. But
would have been right at the peak.
Yeah, but he's in sort of involved in real estate. He's a builder / handyman and works for the real estate agents. And it was one of those ones where the owner was overseas, a doctor working in Italy, just wanted to offload something, didn't care how it unfolded. It was sort of
get rid of it,
off the market sort of thing, and we couldn't sign it quick enough. Actually, we got gazumped for about a day, I think, as well. So signed it at $500,000. One of the other handymen found out about it and offered it $505 to the.
Okay.
Yeah, we eventually got it, I think, for $505. But
what was it for Newtown? For those of you who don't know, it's not inner city, but it's pretty close. 5Ks from 5Ks.
I think
5Ks from the CBD along the sort of train line belt out to the western suburbs. So very attractive area with students and more of the alternative crowd. It's very vibrant music scene out there and restaurants, cafes, all this sort of stuff. Good transport links. So good sort of inner ring suburb. What'd you get? It's an apartment.
So it was just a one bedder.
Yeah.
So my dad's got, I was going to say, he's definitely got another one in the building. I'm not sure if he's got two in the same building. So my dad's a bit of an investor as well, and he sort of got me into the whole thing. I remember when I was like 19, 20, he was like, you should invest and do this, and I just wanted to party and be a rock and roller and whatnot. So
which is the right thing to do when you're at that age.
Pretty much, yeah. Actually, I did invest in a property with him. I think I put like 10 grand in, and then I needed to take the money back out to buy a Boogie amplifier, and he let me. And I said to him, you shouldn't have let me.
Has that amplifier gone up in value?
I think not.
Probably ended up on a street curb getting thrown out at some point.
Probably got a guitar through it now or something.
Yeah, as all good amps should do at some point. So the question, what's going on in the property? So, it's interesting. The reason why I asked you that question was, it's funny where people are interested, to get their instant interpretation of their experience with property at any given time. It's a funny question to ask.
Yeah.
Because you went down memory lane, right? The last thing you bought and the trigger point for it was at least got renewed today, right? That's it.
I was talking to people, when to buy, where to buy, and I just zoom out from all of that and just go, well, when's the best time to buy? It's probably yesterday, right? So I know there's smarter places to buy, and you don't want to be too silly about it, but for us personally, it's a real long game in terms of when we're buying stuff. We're like, what's this look like across 30 years? We weren't trying to get into it for a quick dollar. It was literally, what are these properties going to look like when we're old and grey? And I extrapolated the figures. So I just did. I'd see clients, older clients. This older Spanish lady in particular. She, had tens of millions of dollars worth of properties, and I'd see her buying in Bondi in 1977 for $8,000. You're like, wow, how cheap does that seem? And then you just sort of reverse engineer the maths on the compound interest of it, and that was just a normal price at the time. It's just gone up like maybe 7 to 10% or something. And when I started seeing that sort of repeat, you go, okay, this is a good game. I can play this. I can get in the market. I don't have to do very much other than wait a few decades. And given it was more of a side hustle, that was sort of simmering as I did work and business and whatnot. My goal was not to buy an amount of properties in terms of a number. It was more around how to value a dollar worth. And then I went, okay, if I get it was $3 million worth of property, and if I'm going to have X amount of loan against that, but if it goes up whatever over the years, and I just did a few models across 3% compound interest, 5% and 7%. And if that model worked across my 3%, then I was sort of coming out on top. So,
and that scenario, that process you went through, I encourage anyone who's listening to this to go and do it yourself. Go and have some fun. Open up an Excel spreadsheet, do some different modelling, and it's only when you see it in black and white you start actually understanding the value of compounding growth and time in the market, as much as time in the market is critical as a property investor. So a couple of things there you're talking about. One is sort of longer term strategic goals in investing in property, point number one. And point number two is sort of the mantra or the doctrine that you use to effectively invest in property. So dealing with the first one, why you're investing in property, is this because you want to sort of retire as a rock god somewhere and just play the guitar all day, or
don't we all?
Or have you got something more grand in mind? Like why are you doing this?
Why property? So it had an interesting time. So before I was a broker, as I was just saying before, I was just muso for all my 20s. My wife was making good money, brand manager. We moved over to London, and I still wasn't famous, right? So came back here. And
are you famous and I don't know? It's happened to me before. I chat to someone and they go,
we got Triple J and no, but not Chili Peppers style, right?
Yeah.
And so came back and so early 30s and going, what am I going to do? I've got to be an adult. I've got to be a grown up. Wife, wants babies. We delayed that a little bit with a dog, right? Inevitably, it was going to happen. Yeah. So I was working in the disability sector and making no money, and then I had this old family friend. He was actually a friend of my grandfather's, and he was worth probably had about $11 million worth of property and owed about maybe a couple of mil or something. Old Italian guy, and he had boarding houses in Campbelltown that were bringing several $100,000. So actually, and I think I got into the liking of property investing through the Reno. Is it the Reno Kings? I saw one of their seminars, and some dodgy characters anyway. And I went and met this guy. His name was John Franco, and I said, "Talk to me." And he brought out all these, all your magazines and all that sort of stuff and books, and I was smelly from the 70s and 80s. He was an architect and all that sort of stuff. And he goes, "Buy a property, build a granny." And he started ringing his agent in St. Clair. Yeah. And he's like, I'll get one now for you. He's like, he's not getting it on the internet, this guy. He's like 80 years old. And when I started seeing that you could, leverage, and at the time you could borrow up to 98%, little deposits, 5% deposits, whatever. I'm like, this is a game I can play, like from where I am with no more education or whatever. So, we bought our first two investment properties at that point, And at that stage, I was just absorbing as much about it as I could. The job I had at the time in the disability sector, I would literally have 2 or 3 people around me a lot of the time, and I was just talking property investing. You should do this, don't pay LMI, So that's when it came about. I should become a mortgage broker, and got into that. And then when I got into that, that's when I started associating with accountants and buyers agents and all that sort of that space, and that's what really accelerated me. I was just a sponge and just wanting to learn whatever I could from if someone had any more properties than I had, I wanted to take them out for a coffee and learn
work out why.
Yeah, where they're buying, what they're doing.
So where are you going with all this?
So at this point now, we bought up to about, I bought 10 myself, and the 11th one was a half with my dad. We actually sold a couple. Like we got into some of the shitty areas up in Queensland, which I sort of...
well, let's not name suburbs now that you've called them shitty. So
no.
I don't want to get any more hate mail.
Oh, the shitty areas everywhere. But and that was off the back of...
I'm going to pick you up on what makes shitty, by the way, but we'll talk about that later.
Oh,
right? No,
man.
let's not go there now. Let's finish what we're talking about. This is the why. Why are you doing this?
Me and Jeremy are writing a book. We've got some more stories. I'm sure everyone does, but hey. But I think if I was to do it again, I would... Like my dad was just saying, he just buys in Newtown. He's just got stuff in Newtown, Glebe, Ashfield, because he loves it. He can see it. He's tactile as a builder.
Can't go wrong with that.
Yeah. And he has it. And while he's buying in Glebe in the Peak and I'm buying somewhere else, he's like, what are you doing? Like he's probably going to made 150K while I've made 20.
Yeah.
So I would do nicer stock if I was sort of having my time again.
But you've got your time right now. So why are you doing this? Are you going to retire on a beach?
Sorry. To me, it's one thing I could do out of many. So I knew what it would look like if I didn't do it. So my original plan of doing it to begin with was to get an amount of property, 3 mil worth, wait, and I'm not going to say 10 years. People will say, it'll double in 10 years. I'm going to call it like 15, 20, even give it 30, whatever. And the loans would technically... Back in the day, would say they stay the same at interest only, but now we're going to pay the suckers down, right? So technically speaking, the loan's about the same, maybe going down. So I worked out a figure that I'd be left with, if it doubled in value, loan stayed the same, and then I'm left with this chunk of, what to do. If I sold them all, I'd end up with cash, and bought commercial property on the other side of that to generate income. Put the junk in the bank, unlikely, but the point being was I would have a significant portion of cash, equity, whatever, sell half down to pay out the other half. And if I didn't do it, I knew what that looked like. So it didn't seem risky to me in that people say property's risky. I feel like it's risky to not do it, if that makes sense.
I get that completely. And, what you're doing is you've talked a lot about the tactics in order for you to use property, the utility of property to get to an end game at some point. It sounds like, number one, you like doing it. You do it because you can do it, right? And you want to do it. And it's an enabler for you. And I think sort of taking you out a bit out of a career that you particularly weren't that attracted to. And it's given you new potential, new upsides. And eventually it's going to give you choice, right? And that's what I'm hearing. It's just, I'm the same. I don't know why I'm investing in property. All I know is that it's the right thing to do, and I can do it. And if I do it right, the upside potential for it is going to allow me at that point in time when I want to realise what I want to do with it, the purpose for having that. That's the way I see the world.
Well, you don't meet many people that have bought a number of properties and they're like 50, 60, 70 and then turn around and go, I wish I didn't do that.
Yeah.
Right? They're always like, why did I sell that one? Why didn't I get more? And this guy, John Franco, he nearly got devastated in, I think, the 70s and the 80s, doing small developments, the interest rates going crazy. And so that was always important to me to have like significant buffers. And even when I see clients that have stuff all sitting there, like I'll say, no, come back when you got...
So this goes to the second point then, your sort of your investment doctrine. So you said beforehand, it's a long-term game. So you got to sit it out, right? You buy when your hair's not grey. You look to realise and capitalise on the benefits of your investing when your hair turns grey, right? It's one way to look at it. And then you said another thing for you is having really good buffers. So you don't want to be under stress or under pressure when it comes to property, because you sell your property at the worst time when you're forced to sell it. When you choose to sell it, and you can wait until you sell it, is when you if you do sell it, is when you get maximised it. So they're two different sort of key points that sort of help you shape the way you invest. What else is there?
What excites me is when you look back and historically see what property's done in Australia over the last 150, 200 years. And I even do it on my folks' property that I lived in when I was a kid, or like properties in the family. Like I look, okay, they bought this in 1981 for $37,000. They sold in the 90s for 100. And again, it just always tracks back to. I mean, some of them went up, like 12% compound year on year across 40 years. Even the first property that we bought off my wife's parents, the same thing. It just always fell into that formula between sort of 7 and about 12%. And I just hate doomsdayers, like the sky's falling. What if it falls off 20%? All that sort of rubbish. I'm like, if it does, we'll be there to buy some of that cheap stuff, right?
And that's sort of where we are now. To my initial remarks, the smart investors are thinking that way. Yeah,
all our investors. I'm talking to investors. Real estate agents are rubbing their hands together because they can see all their distressed sellers like freaking out. Yeah, I'm not concerned about the ebbs and flows, albeit up or big or small. I'm just really fixated on what happens over a really long timeline once it evens out in the wash, so to speak. And that's why I wanted to do it really quickly as well. I sort of bought all our stuff in the space of about, I think, 3 years. I was eating it for breakfast. So I'd wake up in the morning and next to me I'd have like on the wall, these properties aren't going to buy themselves. So I'm massive on Tim Ferriss 4-hour work week, putting smart goals in place. So I would say I'm going to buy 3 properties this year. 2 are going to take place before June 30. And then I'd just zoom out. So I'd go, got a limit of 300,000 for each one. What's the yield I'm trying to attract? Is it going to be within 3 meters of a train station? I'd pretty much take all the questions out of it for me to take the procrastination out of it. And then it was just finding them, and I'd go to bed with 500 real estate tabs open, and you're just like, wow. And then you wake up in the morning, you've got to go to work. So those tabs just close all, you might make a quick call. So, but I did it in a way towards the end anyway, with the second half of the portfolio, where I'd just force myself, and it was like if there was 2 weeks left, I would just force myself to make a decision and go, all right, this is what's on the table now, and because nothing is ever perfect.
So when looking at the way you invest, outside of the mantra of hold it long term and make it affordable, or you can hold on to it, it's about really thorough and sophisticated goal setting, keeping yourself accountable, doing what you say you would do, and it sounds like being efficient. Being an efficient investor is an important part as well, and that's something which I think a lot of people often fail to appreciate, just how much it can cost you to buy a property in time. Sitting there and looking at
soul
and soul, and energy and all the other stuff that comes off the back of it. It can wreck relationships. At a worst point, right?
I know, Jeremy's. I know these guys. They love it. People putting. I'm not a fit. Like when I'm in it, I do it. But I'm not.
So you got to be the efficient investor, and I reckon that's a good headline, right? The how to invest efficiently, because you don't want to spend 500 hours, of your time to find a property. Start adding that up at a basic, at $50 an hour, right?
Oh yeah, and
it's a lot of money.
And you do what you can control. So I was like, I can't control whether I buy a shit one or not, right? Like that's out of my scope, and I've had some, right? I've definitely had a few, but I'm like, what I can control is just doing and being in the game. And my philosophy is, if I'm exercising the decision muscle to do it, and I'm getting down and dirty, that's I'm in the game. So if I pick up a few crappers along the way, I'm learning, and I know what not to do the next time. But I'd rather do that than just sit on the sidelines and procrastinate.
It's okay to make a decision. It's more important to make a decision and realise that you've actually made a bad decision. Get out of that, and that's where most people get stuck with shitty properties, to use your word. And maybe we can move on to that. I would say you don't want shitty properties in your portfolio, and I apologise in advance. I don't usually swear on this podcast. I don't think I do. That's all right. We'll call them shitty properties. It's okay. I think most people are okay with that word these days. But you want to try and minimise making these poor decisions, right? That's the skill of being a smart property investor. I think every investor you speak to like yourself, who has been at this for a little while and transacted property and got a reasonably large portfolio, everyone will have a couple of them in their portfolio because they've just made a wrong decision at the right time. Thing is to minimise that as you sort of advance as a property investor, make sure that you get rid of them. So your definition, what is inverted commas, what is a shitty property from your experience, and how do you avoid them?
One that
now?
requires my time.
Okay.
So even the numbers aside, like even just a poor performing one that's not going up, and we've had that. So we bought in like Mildura.
Okay.
We're buying prediction reports and all that sort of stuff right in the early days. I really wanted to be passive because I want to focus on business and other things. So I was at a point where I had like intricate spreadsheets. I was filling it out every single month of all the incomings and all the outgoings and if formulas with all these parentheses around it. And I was like, what am I doing here? So then I did an experiment one year where I did nothing within reason for the whole year just to see what would happen when all the annual statements came in from the agents, and then I just plugged all the figures in then. And it took me maybe 5 or 6 hours, but then I realised I didn't have to spend all the time throughout the year. But going back to the question, just bad tenants. So I've had guys. So this is crappy property, like tenants' ex-boyfriend getting out of jail, punching the person that's on the lease, so she moves out, and then you've got a squatter that's just got out of jail, and you can't even do anything because you don't even have the lease with him. Possums in roofs, pools. I don't want properties with pools. I got stuff goes wrong, lots of stuff like cracks in the bottom of the pool.
Yeah, concrete cancer, and you can't just fill them in. You got to get rid of them.
Yeah. So crappy properties are ones that, to begin with, they just were old, unrenovated dungers, as we'll say, and you're sort of going, oh, awesome yield. I think one of the top yields we had was like 8.13% or something. Great yield. But yeah, you very quickly, think things are going wrong. So for me, I'd sooner buy something nicer these days, or go in and renovate and have it. So you just don't have to worry about that stuff longer term.
So crappy properties are properties that don't go up in value.
Yep.
Yeah. Crappy properties are properties that require a lot of emotional and time investment to ensure that they can deliver the returns you need to deliver them in order to receive the cash flow you want to receive, i.e., jailbirds squatting in your property, and that's unfortunate. And I completely agree with you. I think it takes people time actually in this game to actually understand and appreciate what crappy is, and crappy for one person is crappy for someone else as well. Some people like the challenge of having to manage properties like that. I don't want to do it.
No.
I've got better things to do with my time, and I think going back to the point around what you want as an investor, it's about the predictability of the performance of the property to do what you want it to do. Now, a portfolio is I've never really thought of it this way, but a property portfolio has its particular tool or utility, right? So depending where you are or what your portfolio looks like, you might have a property which is really badly yielding, but it's growing rapidly or quickly or at a steady rate in capital growth. Alternatively, you might have something which yields really well, but it doesn't really sort of do too much in capital growth value. And these are all parts of the makeup or the complicated makeup of a portfolio. And as you become a more mature property investor, more properties, you find that you start thinking about property differently, and then each property in your portfolio has a particular tool. That doesn't make them necessarily crappy. The crappiness is when the predictability about what you're trying to achieve doesn't work out, and that for me is the key point. And it sounds as though that's how you frame crappiness,
yeah.
Right?
I think you said it right. Like there's some. If I look at our portfolio now, I look at some of the properties, and I just know that over time they're going to just continue to do well. Like your Sydney, the Newtown one. There's this one in George's Hall, one in Liverpool, but still there's a part of me that doesn't want to sell it. I know in the next 10, 20 years, Liverpool will be the next Newtown, right?
It's getting there. Yeah. There's a huge skyscraper out there now. You see it from miles away.
One of many, right?
Yeah.
So, and there's other ones where I'm like, I don't see that, but they're not, they're not bad, but I'm not sure what I see with it. So, it's just about, and even when I run that compound interest at 3%, 5%, whatever, there's some that I'm not as confident running it up to 5 or 7.
But that gives you projections at least in the way in which you can benchmark the performance of your property or or the assumptions that you're making. So, you know, back to my point, I'd highly encourage anyone who's listening to this, go and do that. I've done it. You know, lock yourself in a room one afternoon or a weekend and just sit there and tinker and actually look at the relationship between growth, the compounding growth and time with the value of your property. Because until you actually sit in there and you put the formulas in yourself, and you sort of there, just Google how to do a compounding growth formula or something or other for Excel.
Cut and paste it.
You know, just cut and paste it in. Go and do that exercise, because when you start sitting there, you'll find it quite addictive. When you come up with these assumptions and you can put some different percentage increases and all that sort of stuff, go and work out that relationship of how it works together, because we can talk about it and we can say, hey, look, this is how it works. Until you go and do it, you don't really know. And that's what I take away from this. And also stay away from properties. I could see the headline for this, Matt Preston on what makes property crap or something or other. It'll be a good hook and people are listening in. The crap property guy. So, mate, Matt, I really enjoy the chat. Good fun. Have to keep in touch. Let me know how you're going. When are you going to buy next? I'll close with this.
When?
Yes.
I have no idea.
Okay.
No idea. But even that last one we bought was fell in our laps and we couldn't jump on it fast enough. So, at the moment, it wouldn't be quick acquisition stuff like last time. It would just be if the opportunity arises. There's been a few that float around that have been talked of. More joint ventures, though, I would say.
All right. Well, let's get you back in and have a chat about that at some point in the future. It'd be good.
Excellent.
Thanks for your time.
No worries.
Let me know when you're going to get this book out on how to avoid crappy properties, and I'll do a critical review of it. And
please do.
Yeah, give it 1 star, no doubt. But no, I'm sure it'll be
good.
Crappy review for a crappy property. No, I appreciate it, Matt. Remember to check out smartpropertyinvestment.com.au if you're not yet subscribing to our daily morning newsletter. So you're the first to know what's happening in property and property investment. smartpropertyinvestment.com.au/subscribe. If you're a social media person, just search Smart Property HQ and you'll see what we're up to. Keep connected and engaged and be the first to know what's going on. If you like what we're doing here and enjoy this podcast, wherever you're listening to it, just press that subscribe button to make sure you get every episode fed straight into your podcast machine. I use an Apple iPhone, but everyone uses different stuff. And any questions at all for this podcast or any of the concepts we've spoken about, or even if any additional questions for Matt, you can email the team at editor@smartpropertyinvestment.com.au. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.